I wanted to take a moment to mention today's live stream supporter, Vantage. Vantage allows traders outside of the United States to trade CFDs. You can trade everything from commodities like gold, you can trade US indices or global indices, and you can even trade FX all under one brokerage, and you can connect to MetaTrader 4 and trade directly on tradingview.com. Not to mention, they also have a really good sign-up bonus going on right now. So we'll drop the link to that down below in the chat as well as in the description of this live stream. Check out Vantage. Now back to the show.
Hey everybody, happy Thursday. Welcome back. How are we doing today? Let me go ahead and share the screen and let's get cracking. So I am looking at a couple of things here. So we're up a little bit on the morning. SPY's at 526, still clawing back. I think to be on the safer side, I'm watching this 200 EMA very closely. So it's sitting here value-wise around 507 to 506. As far as a pullback goes, I'm just using this recent sell-off here the last 4 weeks. So week 1, 2, 3, and 4. Just looking at some typical retracement levels. We hit the 382 yesterday. I was short yesterday at that level. I had a nice little 520 put that I ended up, it was on the SPY. So we're trading up here around 5. Let me check the SPY out yesterday. So yesterday we were trading up towards that retracement level around 530. I ended up taking a 520 put, but I put my expiration out to Friday, paid $1.75. It was trading as high as $5.50 yesterday. I closed it out for $4.20 for a nice little gain on the day. But if I go back to this chart here, I'm looking to see if this is going to end up getting faded down. So from high to low. And, you know, we come back into, we hit the 382. If we end up finding, this is really the decision point, in my opinion, right here is where the market's going to be forced to make a decision. I think that decision is going to be more to the downside to retest the same low again or retest this EMA. And so what I'm going to try to do is stack up some short-term hedges to those levels. If I wanted to just simply be long and maintain some time value in that, I could probably go out to October. I don't think it's going to take that long to revisit those levels to maintain that, but it's going to be more expensive as a hedge. So the hard part is, and this is what I'm debating on, this is why I haven't taken the trade yet. I'm debating on, do I take this trade kind of week to week and expect there to be like a high volatility week to return, or do I just go out and play it a little bit safer and say, okay, by the end of October, I think we're at least going to have a retest of these lows. So let me debate that as we're talking through things today. I want to review, you know, all the major instruments here. The one thing I've been watching all week has been the Nikkei 225 and the currency strength chart with the yen and the Swiss. So one thing we had this morning was the yen was strong, and it's faded most of that down. The Swiss was strong. We faded some of that down. The volatility is a little bit more contained today than it's been all week, which is not a bad thing. And we have the yen just bouncing off the lows a little bit. The Swiss is weak, but volatility, like I said, is somewhat contained in the Forex market. Now, one thing that could be interesting. So let me see here. If I were to look, I'm trying to price this out. And if I do a debit spread, I need to be careful on a debit spread because if the sell side changes, that's going to, I don't know. I think my sell side is probably going to have to be like 500 or lower to make my trade a little bit cheaper. So let me just evaluate this right now. So if I did a 525 by 500, let me see what this is going to cost me. So if I went out to, let's go out to the end of the month. We've got Jackson Hole, I think at the end of the month. Let me double check that. When is Jackson Hole? Jackson Hole Symposium dates. August 22nd to the 24th. Okay, so that is 22nd through the 24th is a Thursday through Saturday. I mean, last year's Jackson Hole was a wild ride. We had a big swing up and big swing down. I mean, I guess I could hedge out to the 30th and see if it's a little bit more cost effective just to incorporate that move. Let me assess. I don't need that up anymore. All right, we're trading at 525. I did collect $5.05 this morning on a strangle. So this trade on the SPX. I did this morning. I centered it around 52.55. It's up a little bit, but if this just hangs out for another maybe 30 to 60 minutes around my center price at 52.55, I can probably extract my $75 credit that I'm looking for today. And then on the SPY itself, going back to this chart here, I think I'm willing to go out to the 30th. So I'm going to go 30th, go out to the SPY, and go out to the 30th. So if I'm looking at, I don't really want to buy at the money. I wanted to try to go out of the money, but maybe like a 515 and take this down to a 500. So I give myself about a $300 risk for a $1,200 profit. That's not too bad. I give myself a little bit of runway. I can make this a little bit cheaper by going further out of the money, but how much cheaper? $1.70 for $2. Maybe I'll get this for $2. So if I did a 510 by 498, it's going to cost me $2 if I do 5 contracts of that. So what I'm looking for here is if I'm correct and have some time value, I can probably see this double in price if we do this within a reasonable amount of time. Like let's say now until like Jackson Hole. Let's say that we retest this level like next week, then this is probably going to be trading for $10+. I can double my position. So what is I'm paying $2. I make, let's say I pay $2. I make $8 because if you're trading for about $10, I make $8 on 5 contracts. I make $4,000 on the trade. That's a decent hedge. I want to go a little bit further up and out. Maybe there. Let's see here, 400. That's a little bit pricier. That's still less than 1% risk for 6,000. I think this is okay. I'm gonna take a hedge in this one, and this is about a 0.5% hedge. Let me do the math here. So if I did a 1425 divided by, so I'm looking at a 0.5% hedge that pays about 2%. So we're talking, maybe a 3-to-1, 4-to-1 hedge. 6,000 divided by 1,400. I'm looking at about a 4-to-1 hedge. It's not too bad. I wish there was more, but I think this is fairly safe. Let me try to get into this for a little spread here around 290. I'm going to try to get this for 290 for everybody. I've got plenty of buying power, which is nice. So I'm going to take this trade right now. Shout out to my man Vincent, who left me a comment. She's like, "You're a weatherman that just talks charts." So I guess that's what I am, even though I'm sitting here live trading in front of you, which I typically do. So anyway, shout out to Vincent. Hope you're watching. So 515 by 500. This is going to be a bear put spread. 285 is the mid. I'm going to see if I can get 285, but I'll be willing to pay up to 290. See what this looks like. So here, 285. I'll just take the 290. I know I can get filled there and not worry about the mid. 290 filled. All right. Let's go all the accounts now. Okay, just give me a second. Come on, you're not filling at 290 now, you turd. Let me go. This account got filled at 289. This one here pending at 290. Try to take the mid at 293. Dang it. Okay, I think I just took, hang on. Okay, we're good. Now, same trade on this account for 290 again. Got it. Okay, let me add this into my trade tracker. So this is a 0.5% hedge, pays about 4.2 to 1. SPY hedge. This is an August 30th expiration. The 515 by 510 bear put spread, paid $2.90 debit. This is a $15 max profit. Trying to give myself some runway. So realistically, I mean, if this ends up paying me over $10, I'll probably still take the profit. So I pay 290, I get out for 10. Let's see if I can, and I might just set the credit at $10. So 10 minus 290 is a net 710. Oops, 710 divided by 2.90. I could still take 2.4 to 1. I'd obviously like more than that, but I think that's safe as a little bit of a hedge. All right, so that trades in. I was looking at the futures market to hedge. I might just try to put in some short terms. I also wanted to revisit. I have some pending orders that I'm going to adjust. Let me check this on the SPY right now. So let me go to an individual account. FX World. I like your energy, bro. Thanks, man. Vincent. Vincent, is that you? Is this the Vincent that I love? Maybe. Anyway, let's keep going. So I have some pending orders here: the 505 by 504, the 500 by 499. This 525. I'm going to get rid of this 525 one. That one didn't fill. I'm going to cancel. So I'm gonna cancel this one very quickly. I don't like that level necessarily, even though it was longer term out to November. I'm just going to get rid of that one. I was trying to get filled for 45 cents on the dollar, but I'm just going to try to take my chances at the 500 level. I might actually switch this instead of doing the 525 by 524. I might switch this and do like a 510 by 509 or a 510 by 500 or something like that. So if I see this 525 by 524 that didn't get filled, I'm going to go ahead and cancel that. So give me a second here. 525 by 524, cancel. 525 by 524. And 525 by 524. This one does not have that. Okay. Cancel. And right here, cancel. All right. So instead of that trade, I was going to look out to the end of the year or close to it, probably in November, December expiration. Let's see. I might do both. And like the 510 level would be, if I can get filled, I'm going to try to do something at the money, like 40 cents on the dollar, 45 cents on the dollar. If it's a, so I noticed that the spreads today are much wider. When I went to August 30th, take a look at this. August 30th is okay. What was I talking about this morning? Maybe I was looking at October. Check this out. So October 31st. Nope, those just filled right up. What the heck? What expiration was it looking for? I don't know. I thought there was some different expirations in here. Oh yeah, here it was. So I did the October 18th expiration. I was looking at this earlier this morning, and I hate this because this is arguably one of the most liquid instruments in the U.S. markets, and we're sitting here talking about at the money is fine, but as soon as you break below 520, you have $5, $5, $5, $5, $5. That is a much different trade than getting a dollar strike. You can be way tighter with your risk with dollar strikes, and you get way better credit. Pennies on the dollar. It's like it sucks. So I mean, this will fill up eventually as we get closer to October, but it's unfortunate that right now you can't go out a couple months and go out 70 days and get a decent fill. So I hate when they do that on a liquid instrument like the SPY. They take away all the strike prices that really make your trading a lot easier to manage. So obviously, I'm not going to use that. But if I look at that 510 level, could I get filled at something like end of November, end of December at the 510 area? Probably. I'm going to try to get filled here at like a 510 by 509. And I've got a good lesson for us to discuss today too. We talked about this a little bit yesterday. I relabeled my session yesterday. So recording that I did here with the team, probably the most important video that we've done, or I've done personally, the entire year. Like it put a lot of things in perspective. We looked back and found out, the most similar example of this volatility event we experienced on Monday was back in 2017. So I actually looked at that again this morning and last night. I think we can take away a lot of that period and apply that to what we are probably going to see here play out. I mean, as they say, history doesn't repeat, it often rhymes. I think there's a good case for this market to play out in a very similar fashion. Okay. So anyway, November 29th, I'm looking for a 510 by 509. Try to get about 40 cents. I'm going to try to get 45 cents in the dollar and load this up for about oops, not time. There. What happened? November 29th. Okay. So if I do the 510, so I'd sell the 510, buy the 509. It's traded for 25 cents. I'm not interested in 25 cents. I'm trying to get 45 cents out of this one. And I'm looking for quantity, not expiration, quantity. So 5 contracts. I think I'm going to do 10. I'll do 10 contracts here. Take a little bit more risk than reward, but my probability is okay. Now, if I'm doing 10 contracts, I'm not going to take 1,000 shares of the SPY. If I'm doing one contract, and this is what's kind of nice, I could actually close. Let's say that this market is going to tank through everything. And we're talking about, oh my gosh, the SPY is going to be a 20% correction or 25 or 30% correction. Look, I can take a -9 and a +9. Oops. I can take a -9 +9. So I'm going to do 10 contracts here. I can take the -9 and take a loss. I can take the +9 for a loss. And then I can keep the one share and I can actually own the SPY if I can ride this down lower. So if this SPY surprises us at like a 15 or 20% level, I'm going to take shares of the SPY. I'm going to allocate the buying power that I have, and I'm going to work this thing for, longer term. If we're down 20%, I'm going to take a chance because, how bad does this get? I mean, the market would have to crash like 50, 60%, and that would be, certainly the culling of this giant overbought asset bubble. But I don't think we're necessarily in one, right? I think right now this is the CapEx overspending and the AI hype that is having a bit of a reality check. Right now, what I'm seeing is earnings are coming in pretty solid, pretty consistent. That's a good thing. We saw the unemployment hit the news today. It came in lower than forecast. The market's taking that as a good news event today for now. But I think we're going to retest. Okay. So anyway, I'm willing to take the shares. So even if I lose on the credit spread, I can make it up with own shares, and gladly have it over the course of the next 6 to 12 months and repair it, collar it, and things like that. So anyway, can I get filled here at 45 cents? That's what I'm going to try for 10 contracts. Buying power wise, this is going to take up about $550, no problem. So let me throw this in here. So let's go buying power there. I'm just going to copy this trade for everybody. So 45 cents, similar. And now give everyone some action on this one. Okay. And 3 more accounts here. All right. Now I'm in. All right. I'm going to track this trade. SPY. This is a November 29 expiration. 510 by 509 for 45 cents credit. 10 contracts pending. Okay. So that's in, that's pending. And we'll see what happens. All right. So right now, still hanging out around $20 above my center price. See if I can extract out some of that time decay really quickly. See what this is trading for right now for today. It's trading right around where I got filled at 505. Okay, so that's just going to take a little bit of time. IV today is reducing. VIX today heading lower again. So we were slightly elevated this morning at 28. All right, this is a good example. Let's go back to 2000. Doesn't this trade have to have bigger decay due to being so far out? Which trade you talking about there, Robsy? The 510 by 509. That's a bullish trade. All I need on that one is I need price to go a little bit further. So it's a credit spread. So what I need price to do, let me go back to the SPY here. I'll just walk through this trade for a second. So what I need price to do would be this. If we end up coming down, and the reason I'm taking this trade is I think the higher probability right now, and this will all kind of come full circle when I go back to 2017 to 2018, I think this 200 EMA is going to get hit. I mean, we've had a low volatility run, and I'm telling you, like, this is crazy similar to 2017, 2018. So I think this market, if the bulls are going to pull this thing back, I think the bulls can stabilize in here very easily, right? If there's enough eagerness out there to buy the dip and have this be a one-off vol event and a panic that now we're buying, it's a buying spree because that was the cleanse that the market needed. Look, I can see that trade playing out. Okay. But if we pull back into here and we find the same equilibrium only to see this market want to try to retest this low, that is the trade that I'm talking about. I don't think that the VIX goes straight up to 60, drops to 20, and just goes back to the teens. I think this goes up to 60, down to 20, and then possibly has one more spike up into the 30s or 40s before it settles in over the next couple of months. Seasonality wise, August, Jackson Hole, it's low volume. It's always a weird month. Okay. It's always a weird month. September is known as the September effect, where it comes out of summer trading and we usually have a lull and we have one of the worst performing months ever in the history of the stock market. Now, that doesn't mean it has to be ridiculous, but it's like typically averages like 1% down, 1.5% down. I think you can take a look on the Edge Fighter. We have some seasonality here. Let me check. So let me go into Edge Finder Pro, go into seasonality, and then go the month of year trends and go to my SPY or SPX right here. There you go. Okay. So you see here that August is usually a positive month, but we finished the month of July barely positive because we started to give a lot of it back that halfway point when we topped out mid-July, gave a lot of that back towards the end of the month, and then August, of course, is off into a rough start. September, historically speaking, is a down month. Okay, so for us to bounce, I mean, are we going to bounce and just recover in September? To me, that's unlikely. I think September is going to be more of the same and more of, how serious is this bull market? I mean, look, September, October, historically for the last 10 years, last 5 years, don't bode well for the market performance. So we might have to be waiting for a Q4 situation to get ourselves a rally, and October might be where we're looking for those bottoms. That's not easy because there's a lot of other stuff going on geopolitically that might kind of, spoil the party. I listened to interesting podcasts yesterday where all these things like frothy AI and earnings, and it's disappointing, and employment's up, and the SOM rule's in effect, and I get it. Like, all these things are happening. I don't think it's 2008. I don't think it's 2020. But like I said, it is pretty similar to what we saw back in 2017. So on that note, I want to go back to 2017 for a second. And so let me finish up that trade at 510. So if I put in a 510 by 509, okay, so that is a sell put right here and a 509 buy put. Okay, realistically, for me to collect about 45 cents credit, this should be something that trades at the money. So if I did something right now, if I were to go right now to my same expiration, which would have been November 29th, right? So if I did on the SPY the same trade out to the end of the month, and I did an at the money bull put spread. See how I'm getting 37 cents right now? I mean, realistically, I should probably look at like a 40 cent credit. But what I'm looking at is if we dip down to 506 or dip down to 500 on the SPY, that should be enough in the money to get filled at that 45-cent credit. And I still know that sucks because I'd rather be, at the money getting 45 to 50 cents. I don't necessarily want to go in the money because look at that. Even in the money, this is in a bit, this is unfair because if I'm going $1.50 in the money, I'm still only collecting about 1/3 of the width. That's a little bit mispriced as far as, to truly get the value that we want. I like to take credit spreads. If I'm, pretty bullish on something, I'd like to take a credit spread that's at least 1/3, but preferably like, 45 cents, 50 cents on the dollar. And how far up do we have to go? How far in the money do I have to go in order to get this to pay over 50 cents? So if I move these strikes down, now we're talking $5 spreads, but that'd be the closest thing right there. So I would have to go nearly $20 in the money in order to get that roughly 50 cents on the dollar. That's ridiculous. So these prices right now are pretty skewed, and I don't love that. So I'm like I said, it's pending. So if it fills at 45 cents, it's because I'm going to be in the money by probably $5 or $10. And I'll see if it fills. If it doesn't fill, it doesn't fill. But I can obviously, plan B could be I go long a call option. I do an at the money and see what the price is offering. I modified my positions, but for right now, it's just going to sit there with a pend. Okay, so that's the trade. Now let's take a trip down memory lane and let's go back here on the daily time frame into 2017, because what we just saw on Monday was eerily similar. Okay, eerily similar. Now look at this. This is the SPY on the daily time frame right here. This is the end of 2016 and the run in 2017. And if you tuned in yesterday, we talked about this. The one thing that the SPY did that has never happened in the history of the SPY, other than 2017, was 12 straight months of bullish. Okay, every month closed green. That has never happened in the history of the stock market in the S&P. So a very impressive run. Now you can see this chart, and what do you notice here? Okay, I'll tell you my moving averages: 50 period, 100 period, 144, and a 200. When this market tested in 2016 that 200 EMA and got up above that, the only pullbacks you saw all year: 50 pullback, 50 pullback, 50 pullback, 50 pullback, the entire year. We never even came close to bucking that trend. This thing was ridiculously, but low volatility wise, extremely bullish. Okay, so why do I bring this up? Because this market with super low volatility and just this little, sneaky little low percentage grind every single month for 12 straight months got to a point where it was a volatility event. And this was eerily similar to what we just saw. So let's zoom in, and I think this is a good lesson to take away into what we're seeing right now. Look at what happened as this market finally toppled over here at the end of the year into the first part of January. This thing just dumped in a volatility event. Now, let's trigger this. So let's write this down. January 26th. Okay, January 26th, 2018. Okay, because what we saw here is once we had a top, this thing ripped with gaps to the downside and fell very quickly. There's 8% on a sell trade, and it gapped lower to a 9.6% move from high to low. Does anybody know what we just saw from last week? When we opened up on Monday, how much lower was the SPY from the highs in July? It was around 9.7, 9.8%. Very similar. Okay. Now, look at what price did after that. Price came up and rebalanced. And I want to drag a fib on this because we're probably looking at, and again, this isn't going to be the exact same way. It's not going to play out identical, but I'm going to look at history to use it as a reference. Okay. So there is a swing immediately after we see like that 1, 2, 3 days flush to the downside, and then we have a big bullish day to cut back. But what did the market do? The market pulled back to roughly the 50% zone. Everybody see that right here? That pullback right there is right around the 50%. So we go high, low, 50% pullback, and what did the market do? It rips down and it tests the 200 EMA. I could see that happening. All right. So we fast forward to today. Let's just use this as a historical lesson. So we fall aggressively, just shy of that 10% level. We rip back up here towards 50%, and we flush all the way back down to find that 200 EMA. Now, this was after a bar count of over 300 bars on a daily time frame. That is a big extreme on a chart. Okay, I use this all the time in forex trading. I look for it in stocks too. I mean, anything over 250 in stocks is pretty decent, but certainly 300 on a daily is rare to get. And especially, it's not just the distance away. It's not just the time. See how many bars we have here? It's not just that, but it's also the percentage away. Once we stretch a certain percentage away from the 200, that's where I think this made the volatility move back down. So we had a 315 bar count to get to the 200 EMA. We stretched all the way up here over 300 bars. Now, one thing I want to check, how far away were we? So this level right here at the top, all the way down to the bar, was around 11%. So did we stretch over 10, 11% away from the 200 EMA? All these things we're just going to kind of earmark and look and see, like, does this make sense for today? Okay. So are we 10, 11% away from the 200 EMA? And are we looking at that 50% pullback to then come back and retest those lows and hit that 200 EMA? Now, what ensued after that? The 200 EMA is always a sign of a support zone. This is for a lot of the kind of industry standard buy and sell zones. Everyone, have you heard of the golden cross or the death cross? Okay, the golden cross is that you have your 50 and your 200 crossing over to the upside. When you're coming out of a sell zone, you get your golden cross, you look to get back and resume the buy zone, right? So if the 200 can hold as a buy zone support line, you can see that it did this back in 2018, right? We came all the way back up here, flush back down, really nice structure lows, and then we continue to go bullish all the way through the end of 2018 into 2019. Or I'm sorry, into 2018 and stayed bullish through 2018. Now, did we crash again in 2018? Yes, because during this time, quick history lesson, the Fed was raising rates. So the market did find a way to go up as the Fed was raising rates. But when they all of a sudden raised rates for that fourth time, the market freaking dumped by 20%. And in fact, it was 20% to the nose. Like from peak to trough, it was like right at 20%. And then we put in a backstop. The Fed panicked. They started to pedal back and cut rates. And then 2019 led to another bubble. So all I've got to say is from 2017's low vol rally to 2018, this market, heck, it can't help itself. It's so freaking manipulated that it's just booms and busts until now. And it's no different. So, all right, quick lesson. Do we have some numbers here that make some sense? So let's fast forward to today. Okay. Does this look like a pretty good bull run? Yes. Look at the bar count. Okay. From this area here, our bar count stretches towards, look at this. I mean, we had 300 plus bars, and then we ended up finding it 400 bars later. That was a run from COVID's recovery, so shortly in the 2020 zone, all the way up to the deleveraging at the end of 2021 into early 2022. Crazy run, right? Now, how stretched were we? I don't think we were 10 or 11% overstretched. This was at its peak about 8.5% overstretched. So it was more the bar count to me than it was the actual percentage. But we go into this recent run, and I know my chart gets messier as I get closer to price, but just bear with me. This run, I feel like we hit the percentages, right? We have been around 10.5% overstretched from the 200 EMA. Okay, how about this one from this high to low? We were about 11% overstretched. So it's interesting that in April, we started to make a correction as we hit 11% overstretched from the 200. And here we are again, 10.5% overstretched from the 200. And this market's finding a way to revisit it. Now, the last time we touched the 200 EMA is right here. We're about 200 bars-ish, maybe not that extreme. I think it's less than that. Let me check that bar count. So currently we're still going, we're less than 200 bars. So it's not the time necessarily as it is the percentage. All right. Does this make sense? Am I pulling correlations out of my butt here, or does this make sense? Because I think, and here's the deal. If you're looking for answers, you're going to have to look back and find similar examples on the charts, right? Similar fundamental examples, similar things that, economic periods and expansions and contractions of what the Fed was doing at the time. All this makes sense. And it's never going to be squeaky clean and it's never going to be perfect. But when you're looking for answers, look, it caught mostly the world by storm. I mean, I've been planning for this for a while. I was hedged, but the Greeks changed so quickly on some of my positions that it was an unpleasant Sunday to Monday. I mean, I watched futures Sunday night. I braced for the open on Monday morning, and I do feel fortunate that we did actually rip up on Monday. But now, as the dust has settled a little bit, I was able to properly position for, okay, I found the 2017. I look back, I see what the market's capable of doing. So what I'm considering now is I think we pull back 50%. So we've got the 382, we got the 50. If we pull back into that window, I'm looking for this to try to retest the low. Retest the low, retest the EMA. And then from there, we'll see if we stabilize. We will see if we stabilize. If we don't stabilize, then things get way worse. If we do stabilize, it's because we still have this buy zone, and that's a really solid support level at the 200 EMA. Okay. So similar to the 2017 vol crush that we saw. One more lesson that we discussed yesterday. I just want to revisit this. I don't think that volatility is one and done. I think that volatility will find a way to spike back up and maybe go from low 20s back into the 30 to 40. I mean, really, I think 40. I think 40 is fair, and then we try to settle back into the 20s or maybe the teens. If we're going to see, if we're still going to see a Q4 rally in any capacity, I think volatility, goes back down into the low 20s or high teens. But I don't think it's just going to fade. I don't think we go from this and just straight back down to the teens. If we do that, cool. I guess it's easy because the market just goes up again. But don't be surprised if we're going to retest that 200 EMA that we're going down, back up, and then we'll have to settle back in after another potential scare. So I don't think that scare is going to get us back into the 60s or 80s. I don't think we're coming back to all-time VIX highs, but it's certainly something to pay attention to. Now, let's take this back to 2017 because this is the most similar thing that I can find. Okay, that was 2020. This is 2017 into 2018. Okay, so remember how the stock market did this. Stock market for all of 2017 did this into the early part of 2018 into January before it finally started to crack. So if I time this, it essentially did this. Up, 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 super, super low, and then we go there. By the time the market's correcting, this is where you get the big vol spike. Now, what's the percentage? Okay, in a 2-day stretch, okay, a 2-day stretch, this thing spikes up 187%. In a 3-day stretch, it moves up 270%. From Thursday to Friday to Monday, so last week Thursday, last week Friday, and this week Monday, we had over 300% in that 3-day stretch. Very similar. Now, like I said, I think this is a good lesson. What did volatility do? Volatility spikes, volatility retreats, volatility pushes back up, and then we retreat again. Similar. I do think we're going to encounter some higher volatility through the remainder of the year. Does that mean we're going to have fresh bottoms and a bear market? Not necessarily. But I do think that we've got to be bracing for what this next potential wave of volatility is going to feel like. Because it may not be a crash. It may not be a scare like it was on Friday to Monday. Okay? I think what was so difficult about that is the market opened so much lower. We had a 4+% gap in the SPY. We had a 5+% gap in the Qs. The futures market was pushing down literally all night Sunday into Monday's open. It was pushing. And so I mentioned this morning to my traders. Okay. If you look at the SP or the ES feed, so E-mini futures, the only way you could have traded this big fat correction that we just saw over the last week, and it's been cracking since mid-July, but the only way you could have traded this is in the futures market. And I just want to put it out there. I'm gonna give a little shout out to the futures traders out there. You have an opportunity to trade this, right? So that's a drop on Thursday to Friday to Sunday night. Sunday to Monday, you had a clean, liquid market to trade. Now, were spreads getting wider and things getting crazier and implied volatility expanding? Yes, 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 yes. But it was tradable. Take a look at that chart compared to the SPY. Okay, the SPY, how do you trade the SPY? Thursday was a single day sell-off. Friday was a gap lower that didn't go anywhere. And then Sunday to Monday, you just have a gap lower. All it did was it showed a dip on there. I mean, how do you trade that? Right? You gap and go nowhere, you gap and go somewhere, but it's like this market's already shed 7 to 8% of its move, and you're sitting here like there's nothing to do intraday. Like from 9:30 to 4 o'clock, really not a lot happened outside of the market didn't just crap its pants for the entire day Monday. It actually stabilized a little bit and it's helping. Okay, so that's my point. Is this off base or does this make sense? I'm just trying to provide some rational thinking here with what the market can do here in the next maybe 30 to 60 days. I think we're going to see another wave of volatility. I want to be braced for that. I'm okay allocating, 0.25% and 1% to these hedges to the downside. And I'm willing to go out and say, by the end of August or the end of September or into October, I just think that we're likely going to revisit these lows. So I will be watching that. Okay. If we go to the term structure on the VIX, I've got term structure up here. So you're looking to see here that over the next several months, we're looking to see the VIX roughly in the 20s. Okay. Now this changes all the time, but if we see this actual VIX number go up to 40 again, then these are probably all going to be elevated. But you can see that we're likely heading lower, right? We're likely heading lower. So it's going to take time, but like this volatility is now, it's in the system. It's got to make its way. It's like a big balloon, right? You have this big balloon of volatility. It's going to have to let the air out, and it's going to take some time. Okay. So I expect that to be, the next maybe 30 to 60 days. August is a lower volume month. Most of Europe is still on vacation. Jackson Hole is coming. Let me see what the news looks like next week really quickly. So we don't have a lot of major news for the rest of this week. We do have some earnings. It's been okay. I mean, consensus-wise, profit margins are still pretty high, but we know the valuations on the forward earnings is pretty frothy and pretty rich right now in the S&P. But if we go to next week, do we have a CPI print next week? I think we do. All right, this is going to be an important week. So we have employment news out of the pound or out of the great UK. We have core PPI for the US. We have an RBNZ cash rate decision. Let's see if they hold at 5.5. We then have CPI out of the US. So, okay, yep. Next week's going to be a buckle up week. We have retail sales as well. We have unemployment claims as well. And then we have consumer sentiment. So next week, news-wise, we have a lot more on the docket to figure out. This isn't a bad thing. I mean, having PPI and CPI on tap for the U.S., if these are both going to show trending lower, right? The previous print for the CPI was 3%. If we print sub 3%, I think this continues kind of ease the market where it's like the Fed would make cuts based on inflation trending lower and not the panic that's ensuing from a higher unemployment. Okay. All right. So that's my point. So we have some news next week that'll be really important to watch. That's PPI, CPI to the U.S. Then we have some rate decisions coming from the New Zealand dollar, retail sales out of the U.S. as well as consumer sentiment. So that will be something that's important to track. Okay. That was my history lesson for the day. That's how I'm kind of rationalizing and planning for the next couple of weeks, what to do, what to look for. To me, this is a likely pullback into that 50% zone. But this is where the Bears, maybe dig their heels in and try to defend. Okay. So if that is the case, I might look at the same trade that I just took a little bit cheaper. And from up here, do the same thing and maybe go out to the same expiration or slightly farther. I might just stagger out a little bit. And look, I realize that my hedge plays here, I might be sacrificing, let's say 2.5% of my account, maybe 2.5 to 5% of my account. If I'm right, I'm hoping that it will pay 10, 15% profit or better. Okay. What I can't afford to do is be doing nothing and just sitting here like that's it. I'm going to buy the dip. I don't think it works that way. I don't think it's that easy. If it is easy, and this is a easy recovery because everything will get back to normal. I still have some traps in here. If I go to my daily time frames, I have some good profit traps in here that if this market, okay, this is the futures market for the S&P. If this market returns, as long as we stay below 55 and 54, that's a 5K profit trap per contract that I have in the futures market. Now, ideally, I make the most money in here. Okay. This as a whole with the bear trap and my credit is going to pay me around $7,500 per contract. So that's if we stay up here and we stay below here. Now, is that what I always try to do with these trades? No. But if it works out that way, freaking great. And these expirations for me are August. So I'm watching this stuff very carefully. All right. Lee says that would be better if the Fed were to cut rates because they can rather than have it. Yeah, that's what we said on Monday. Of course, right? Look, the whole idea of like the Fed stepping in for an emergency cut, I'm glad they're not. In fact, that would essentially be admitting to the world that the Fed is completely incompetent and they can't calculate, they can't predict, they can't forecast, they can't do anything right because they, overshot inflation by saying it was transitory. They underestimated inflation by saying it was transitory, and then in this case, they waited too long to start cutting, right? And they misstepped, and then they broke the market. So yes, it would be nice if just everybody settles down for a second, let the market do its thing, let the data come in as it's supposed to. I will say this though, it's going to be interesting next week. I hope, for the sake of simplicity, that the market sees better inflation numbers out of the US. Because what happens next week if PPI is higher than expected, CPI is higher than expected, and then the market thinks, now what are they going to do? What if they don't cut now? And we go back and forth with just all this stupid Fed drama. So I hope that's not the case. All right. So here's E-mini. Let me drag this down here. There's my swing, right? If we come back to this, and you can see this with pretty clean trading, if we get between this 382 and this 50 and we start to roll over, I'm going to look to see if this will retest the lows. Okay. Now, could it retest the lows and actually get lower? Sure. We could have a swing with momentum to the downside. This could get uglier. But if I just trade from this level back down to lows, and I am correct, there's definitely some money that I want to be making, because what that money will help me make is that'll help me offset any type of additional drawdowns that I have with the naked puts and the credit spreads and all the things that I'm just sitting on. But with the vol expansion, all those actually show, look, defined risk in a trade, like an option. If I have, and here's a good example, Tesla. Okay. I have a trade on Tesla that is a 205 by 200 ratio spread. I'm willing to take the shares of Tesla. Okay. If I'm assigned, if I'm willing to take the shares, depends on buying power. If I take the assignment, I'm going to tie up about $19,000 in cash to own Tesla. Okay. But if I tie that up and I can get for 30 days, $6, $7, $8 of credit, I can lower my cost basis probably every month by, let's say, $7 or $8. So if I own Tesla, I think I could quickly work the cost from 190, 192, probably down to 175 in a couple of months. 150 or lower. And this, I mean, if anybody's familiar with options, I could go on an options campaign and I could lower my cost basis by $50. And I could conceivably take the ownership at 192, work my cost basis down to $100, and then say, I'm happy to own Tesla long term at, $100, right? It might take some time, but I could do that. Okay. All right. So that's that. So real quick, that's my outlook on the S&P. I think the 200 EMA is up for grabs. I think that also, if you look at the Qs, you look at the Qs in the same fashion. We already hit the 200 EMA on the Qs. It's more volatile. It typically is. But if the Qs pull back and do the same type of thing, you have this massive flush lower. We pull back in here to find this gap in equilibrium, and then we see if that's going to come back and retest. If that comes back to retest, volatility spikes up. Things look a little bit damaged. Is it going to be news related next week because PPI or CPI is a misprint? Maybe. Maybe not, right? Maybe the market has an adverse reaction. Maybe we have a super low inflation print and the market still freaking takes it lower. I don't know. The news doesn't matter. It just means that there's going to be volatility and the floodgates open for good movement, right? I don't care what price does. I don't care what the news actually prints next week. I think it matters. It, of course, matters. But to me, this is just a price action based trade. If we're here, I'm going to look to see if the bears are going to fade that move. If they do, I want to be short. Okay. All right. Let's get to the rest of some of my stuff here that I have in my report. So we're good on the indexes. Let's go Dow. Okay. The Dow is also another index that may come down and test this 200. We're typically a little bit less volatile on the Dow, but it would make sense that we have had no test of the 200 for a while. We got a little bit overstretched from the 200 there, and perhaps we're making a quick reversion back to it. So that was around 8% away. We're making our way towards it. Don't be surprised if we have another, pullback, some efficiencies here, and then the Dow gets faded back down to the 200, and then we see what this is made of, right? We see what this 200 is made of. If it's going to give us, a bottoming pattern of some sorts, okay, cool. Maybe I don't know. I mean, is the Dow going to go to all-time highs without the S&P and without the Nasdaq? Probably not. I don't think we're going to get this massive divergence where the small caps do 10% and the Qs are down 10%. That's never going to happen. What happened in July when we had that big weird rotation where the IWM was up like 10 to 13% and the Qs were down 5+%. That's like one of the widest margins ever. So it was a weird like one-off rotation where it just shows that there was a deleveraging happening in tech. Okay. So point is, I still think the 200 EMA on the S&P and the Dow are likely targets to get hit. Okay. The Russell, I was a little bit more confident in the Russell. I could end up making, and this is fingers crossed, I could end up making some pretty good money on the Russell if my levels are steady. The RUT, I have this one. I think it's this one here. I've got a profit trap on a broken wing butterfly at 2050 and 2100. This is August. So personally, I would love to see this get back in this yellow box or slightly higher. If I could pin one of these, it would be about $2,500 per contract. Not yeah, you get it. 200. It's $2,500 per contract because that would be my kind of perfect pin price. The broken wing butterfly. Let me think what it looks like. It would be on the put side, so it would be this. So there's my tail credit, there's my trap, and then there's my risk. So I'm keeping the credit here for like $1.15, and then I have my profit trap if I can peak it and pin it around 2050 or 2100. So if we're ramping up into that zone or we're in this zone, we're at 2070 right now, which means we're sitting right here. But because I'm not quite at expiration, it's not perfect yet. So it's a slim chance that I get it pinned, but in the event that I do, that'd be pretty special because I'd gladly take the the $2,500 a contract profit. All right, VIX. I expect the VIX to rally up again towards like 35 or 40. Just be ready for that. The SPXY, I'm long in this. I don't own any shares yet on the SPXY, but I would basically own it around $50. Okay, it's like 49 and change after if I took some ownership with some cash secured puts, and then I also put in a put here for $3 at $35, which is just an income trade for right now. The dollar index, we're pulling back. Okay, I'm going to get rid of that trend line for a moment. Keep an eye on this dollar. If you're paying attention to the dollar, I think most of us are. To me, this dollar trade is, look, at some point, it's going to make a decision. Right now, to me, this dollar has not made a decision. And that decision being this. Let me make this a little bit easier to read. So there's resistance, there's support, right? This dollar can do all sorts of stuff. Okay. So I don't know. But at first, I thought we break below 104. I want to be short the dollar. But it happened so fast that I'm no longer interested in catching the bottom. I'm no longer interested in trying to short the bottom. So what I'm going to look for is I'm going to let the summer settle in, August, September, see if this market gets into some wide open spaces, and I will stand by this, okay? If the dollar is back up above 104 and this thing gets back up here towards 105, maybe if we see risk off trading, okay, risk off trading, the dollar goes higher. That'd be risk off trading. Okay. Risk on trading would be we are down below this level and we are moving into 100 or lower. That would be risk on trading. If we want to see a higher stock market by the end of the year into the early parts of 2025 or onwards, I think the dollar has to get hit a lot harder than it has been. This dollar hasn't budged at all for the last like 6 months. It's been a little bit up, it's been a little bit down. It pivoted off the holiday lows there at 101. This is not a fun place to trade the dollar. Okay? So if the dollar can make a fresh break below 102, I like this as a basket trade to the downside. With the exception of maybe dollar yen, I would probably focus on shorting the dollar across the board. Dollar yen is going to be on its own little island. Your chance on the dollar yen has already passed, right? If you're shorting the yen at 160, 161, 162, shorting it at 159 when it started to tip over, that was your chance to short the dollar yen. It's done right now. Okay. Could there be more to unwind in the deleveraging? Maybe, but the thing's already moved 2,000 pips. I'm less interested now than I was before. Okay. But if the dollar shows some fresh breaks below 102, that gets a little bit more exciting for all the other currency pairs that are still doing nothing. Okay. And to me, I'm not, I see, I dance, open up a 5-minute chart. I'm not going to scalp the dollar, man. I don't care. Okay. I can't sit here and run a session like this and scalp on a 1 and 5 minute time frame unless you want to hear me not talk. Because if you want to trade like that, then stare at your charts and trade price action. But I'm looking bigger picture because for me, the easier trading is open spaces, right? I don't care if this dollar wants to be noisy today or tomorrow. I care about where this thing's going for the next like 1 to 3 months. Is it down here? Is it up here? That's what I want to know because it is a lot easier to trade to the path of least resistance if we have some clear direction. I've made a lot more money over my career doing that as opposed to trying to sit here and day trade and scalp and pick because look, your 30 minutes a day or your 1 hour a day that you want to trade doesn't guarantee that's a good window to trade. The market's open 24 hours in Forex. The market's open 23 hours in futures. The market's open 8 hours in stocks. I mean, to me, it's like I have a bigger lens. So I'm more interested in the bigger picture. Devinder says should be down, right? Fed will cut rates. Conceivably, yes. Right? It makes sense that the dollar should weaken. Okay. The Fed cuts, the dollar weakens. The only issue with that, and this is not to be wishy-washy and not to say like it could go up, it could go down. The only reason I'm talking like this is because what if we have a recession? What if we have a global recession? What if we have risk-off trading? The JPY, the Swiss, and the dollar are always seen as safe haven currency pairs. So even if the Fed's cutting, guess what every other central bank is doing as well? They're also cutting. So if everybody's cutting and racing back down towards normal interest rates or lesser interest rates, the dollar could stay in this zone and it still remains tough to trade, right? But yes, it makes sense that the dollar gets weaker because of the rate cuts coming from the Fed, and the market might run ahead and price it in for the next 6 or 8 months and plan on this being the next 12 to 24 months of rate cuts. If that's the case, we should see some open space of dollar weakness. If that happens, that is why I think there's a chance for the stock market to stay relatively resilient with a weaker dollar. That's it. Now, is that a guarantee? Of course not. Will I have to watch price and make sure I'm confirming this narrative? Yes. If the dollar's not down here, I have a hard time justifying higher highs in the stock market. So I'm not interested, nor have I been for months. I don't like where the dollar is. It's not a good trade for me. Okay. So if it's to fresh lows, there's room. If it's fresh highs, there's room. That's what I'm waiting for. When do I think we get it? Before the end of the year. Maybe it's noisy through this month. Maybe it's noisy through September. Maybe it's an October shift. Maybe it's a November thing. I don't know. But I would expect that when it's ready to rip, it's going somewhere, and I want to be participating. So hopefully it's clear to read. Hopefully it's clear to see. And hopefully it's easy to trade. Okay. What I don't want to do is look back in hindsight and be like, oh, look, we missed it. I do think there's going to be opportunities to trade it. It's just, let's get some open space. Right. Oil. Nice to see 2 days in a row of oil. I do have an expiration on crude light futures. If I go to positions here, my CL chart. So right now, up a little bit of profit on CL. I've got the 72.50 by 72. This is out to next Friday. So as long as we stay above 72.50, I've got some good profits rolling in on crude light. Natural gas, no trade on it right now. Gold, everyone's favorite. I still like gold. I talked about this pretty extensively yesterday. If we break some fresh highs on gold, awesome. If we pull back and find support, I think there's a bear trap down here around 2250 or 2270. I'd still add to my gold down there. So either a breakout or a retest of support and trend line. If you're scalping in here, I get it. Like, traders are crazy on gold. If you want to, scalp this stop loss below, that's noisy. It's risky. I think this is probably the cleaner trade. Get a break, get a retest, and then get a go, right? Or if it just holds and fades a little bit, see if we can find some support, and then we get another buy trade. I like gold medium term. I like gold long term. So all this is just noise and just either holding on to your current positions. If you're looking to scalp, just try to be very picky about your levels. I mean, look, there could be traders that if you get a break and a retest, you could buy this with a super tight stop loss and have a huge upside potential move, right? So for those of you watching structure, sure, I get it. You want to tighten it up. You want to trade in this really small area, but still look at the good spots. Okay. But gold is noisy for right now. And I've said this, I think this is a bit of a broadening pattern. Like it's just a tricky space. So I think it's testing. But the nice thing is, they're still buying out there. Like, central banks are still buying gold. They're diversifying away from the dollar. They're getting out of US debt, right? So gold and rates coming down especially seem to do pretty well. Hedging against inflation, hedging against a recession. Gold is typically checking all those boxes. So that's a good thing, right? Okay.
Hey, I'm hopping in here, Chris.
So thanks. I guess I'm done. Pull me off. Sand. All right, dude.
Yeah, we got FOREX James waiting in the back, but I want to thank you for coming on today. We just dropped your YouTube link in the chat there. So guys, if you enjoyed Chris coming on today, he comes on basically every single day at the same time. We really appreciate him coming on. But you can go subscribe to his YouTube channel there. You can also find him on Twitter at Real Chris Pulver. But yeah, Chris, thanks for coming on. Guys, we're going to take a really quick break, and we're going to be right back with FOREX James.
See you, everybody.
We often get asked by our US viewers, how do you guys trade gold and indices on a regulated broker? To trade gold, indices, and more, we trade using Webull. And for US citizens watching now, for a limited time, you can get free stocks if you use our promo link that can be found in the description or dropped in the live chat right now. Webull is our top pick and personal choice when selecting a broker here in the United States for stocks, indices, and commodity trading specifically. Get your free stocks now by clicking the link and signing up using the instructions found there. Now, back to the show. Hey, James, I think your mic is muted. I just want to say that before we get too far.
You're right. Sorry, I forgot to unmute it.
All right.
Thanks. So yeah, anyway, what I was saying was I hope you all had a great week. A bit of an impromptu visit from me. I was meant to be away for the whole week, but I came back early to sort some things out. But cut to the chase, what I want to do is start with a little quiz. Now, this was something we did in the Discord. I think it was yesterday, and I thought it was actually a really good idea to just sort of see how you guys look at trades and what type of information you look at. So let's say, now this is hypothetical. Please keep in mind, I'm not saying that this is any real market conditions, but let's say hypothetically, pound New Zealand and euro New Zealand, you knew, you had a crystal ball, or you could see the future, whatever it might be. You knew for a fact that both of them would drop on Monday. And they both had the same risk reward. They would drop exactly the same amount. Which one would you choose? You could only trade one of them. You can't enter into both short positions. And yeah, that's basically the question. There is a right answer to this, by the way. It's not a trick question. But the reason I'm asking is because it can sort of snap you into action a bit. So when you think about this and you get the answer, if you don't know it, it's probably something you are understanding and you are aware about, but you might not think about. And it's one of those things that when you're looking to trade or you're trading very similar pairs, it might just help sway your decision either way. So I'm not sure how many viewers we've got in here. I'm not sure if there's lots of people that will answer. So I'll give you a moment and then I'll show you the reason behind why I'm asking this. So you can actually get the answer in Edge Finder, which is really useful. So it's essentially swaps. So what we have is we get paid significantly more for shorting the Euro New Zealand compared to the Pound New Zealand. So Pound New Zealand's down here. So we get paid positively for both. So that means we get paid positive swaps. So essentially, if we could only trade one of those two, so Pound New Zealand or Euro New Zealand, obviously, like I said, you could only take one of them, but you knew it was going to the downside. So the actual trade isn't really an issue. It's more just how focused are you on the smaller details of a trade. Now, again, it's all hypothetical, but it's one of those little thought things that can sometimes stick with you and maybe help you in future trading decisions, because sometimes I overlook swaps. You can end up paying quite large amounts in swaps if you have large amounts of capital. For people trading a couple of hundred, it's not really that relevant. But there you go. That's a little thought thing for you to start my segment. So we'll get rid of that and we'll get onto the charts. So let me pull this up. Okay. Yep, David. Euro New Zealand was the correct answer. I mean, either one would have been fine. There's not really a wrong answer, but Euro New Zealand is the answer I had in mind. So dollar yen, there's been a lot of eyes on yen at the moment. Obviously, we had some interesting times on the yen. Sherry is, I think I'm really bad at pronouncing names. I'm really sorry. Please don't take it personally. Good to see you. So yeah, we had a lot of eyes on the yen. I don't know how frequently you guys watch me, but I was trapped in dollar yen and Australian dollar yen for quite a while. I'm still trapped essentially in those long positions, but what I have done is I've scaled in, as I said I would. I'm a man of my word. When I say I will do something, I'll do it. If I'm looking at something, it's because I'm actually looking at it. So the yen had a huge run, actually, obviously causing the Nikkei to head to the downside, and obviously dollar yen, Australian yen, euro yen, all the yen pairs had quite significant drops. But we did have some dovish comments by the BOJ, which is the Bank of Japan, which has actually really helped the yen pairs slow down their descent. So essentially, I'm not sure if you guys already heard or not, but they're not looking to hike rates in such volatile markets, which obviously is good. So they gave a bit of a hint there that essentially they're not going to be hiking rates, especially at the moment. So I'm now expecting more of a rate hike towards the end of the year, if not even in 2025. At the moment, I think we're pretty clear of any hikes by the Bank of Japan. So you can see I actually scaled in down here at the 143.55 level. I'm still in my two other positions that are much higher up. So you can see my average price is 152. So once we reach 152.7, then I will be essentially break even on this trade. So that's my aim at the minute. I'm just looking to get out of this position at break even, and then I'll reassess when we get to this pricing and see if we do have any potential to ride it up to 165, which is was my end of summer target. But considering everything that's happened since I was looking at that level, I'm not sure how realistic that is. So when I say end of summer, I more mean sort of mid-September to the end of September. So we'll see. But the reason I decided to take this was because we had a really nice fib level here. I really like to trade off the 50% levels. So when we see a run of 1,000 pips, for example, I like to see a pullback of 500 and then a continuation, which is essentially what we've got here. It wasn't really perfect, but it was still within the Fibonacci zone. And it bounced off this level of support as well, and also mixed that with the dovish BOJ and potential. Dollar looks like it's gaining some strength as well, so it was kind of a no-brainer. At least at the minimum, I can hopefully get out of this at break even. It was one of those trades where it's going on too long, and I just want to be out of it now, clear up some of my exposure, and start allocating capital elsewhere. New Zealand CAD, Euro CAD. This was another one I was speaking about this last week, and I was saying you guys should really be looking at the Euro Canadian. Look at the seasonality. I couldn't give you at the time the reason behind the trade because from one of my traders, not my personal trade. But the reasoning behind it's quite good. So I'll run you through that possibly next week when I've got some more time. But yeah, this is the trade so far, and I'll show you the live execution on this one. EuroCAD here. So you can see I've actually taken it. So really nice entry off a weekly level, playing basically just seasonality. And there is obviously some economic factors behind this one as well as to run as a catalyst. But yeah, just sitting in EuroCAD. There's not really much else I'm in other than the yen pairs and this one. New Zealand dollar. Yeah, we can definitely take a look at that. I'm not sure if it's still on my watch list. It is. Okay. It's interesting, actually. I was looking at this one, I think it was about 2 weeks ago, off this support, and I was saying I would like to see a correction. And we did get this correction. So maybe it would be suitable for a short. Now, I'm quite bullish on the dollar. I'm still in my euro dollar short position. So just a quick sidetrack here. This is my Darwin X account, by the way. So I did take short euro dollar. I'm still in this on my personal account. It's more of a long-term position. But yeah, as I said, you know, when I'm saying I'm short euro dollar, it's not for no reason. It's because I'm actually looking to take it. So yeah, I would actually not mind trading here. Price is underneath the 200 moving average, indicating that we're in a downtrend. We're at this 50% pullback level from previous high to low, bounced off level support. So, you know, just on a technical aspect, doesn't look too bad. And then we could potentially just come down to this next level of support to create a double bottom here. The New Zealand is, New Zealand, yeah, is in a double dip recession. And I think that we do obviously have Fed cuts coming this year. However, I don't think it's going to be a huge issue. So the reason I say that is obviously the Fed cuts will, in theory, cause a lower pricing within the dollar. However, compare that to other currencies. So let's say, you know, Bank of Japan or Bank of England, European Central Bank, they're all looking to cut. So just because the Fed's looking to cut, it doesn't mean that all the dollar pairs are just going to go into the bin. So we'll have to obviously assess that when, you know, when we get closer to the time. But just for now, I don't think Fed cuts would really come into play with this position. I think we should be out, you know, hypothetically speaking, if we did take it now, we should be out by that time anyway. And, you know, there's also the other point that Fed cuts are already pretty expected in the market. I think it's already priced in as much as it can be, really. You think EuroCAD 4-hour uptrend makes sense? Let's see. I'm not sure. I haven't really been watching this one. I just took it and left it. But yeah, I'm not really too bothered about the price action, to be honest. I'm really happy with the analysis behind this. So if we do get any sort of move to the upside, I'll just enter again. So it'll just leave me with another opportunity to scale into a short position. So something along those lines. But yeah, overall, I'm very bearish on this pair for now. So we'll have to keep an eye on it, and I'll keep you updated, of course. But I should be on next week. I'm on these streams quite often. So as long as you keep up the streams, you'll see how it's going. Dollar Swiss. Yeah, okay. So it's as expected, really. We did see a huge amount of fear in the markets. Traders are really dramatic. You know, there's a bit of fear in the markets. The stock market sells off. The yen gains strength. Swiss gains strength. It's quite funny, really. It's all very dramatic for not much reason, in my opinion, to be honest. So saying that, obviously, we had quite significant risk-off markets over the past, I think it was roughly the past week, give or take. So taking that into account, I'm not really in the mindset of risk off, to be honest. I don't really see any reason to be risk off. I think, yeah, although there are some aspects to that, I just don't really see it as warranted. So I'd be quite happy to go long, although maybe not now. To be honest, my technical strategy is saying to go short. We've got bearish trend on the daily, bearish trend on the H4. The hourly is sort of showing rejections at 200 moving average. We're overbought on the RSI. So to go long here, it's not the best idea for me. But overall in this market, maybe when the hourly and the 4-hour trends change to bullish, I'll start looking to buy. But for now, I'm quite happy to sit on the sidelines and just wait for this to sort of do what it needs to do. But the weekly time frame is also really bearish, with price hanging under this 200 moving average. Would have been really nice to catch this, actually. Wrong way around. This bounce off the 200 double top, that would have been perfect. But there you go. Hindsight's great. Best strip pairs to trade 4-hour candles. It's not really as simple as that, to be honest. There's lots of different factors, such as, what strategy do you trade? What economic indicators do you look for? How long do you want to hold trades? Those types of things. It's unfortunately, trading's not as simple as the best pairs. Let's see what else there is. So euro dollar, we did see obviously a lower price on euro dollar today as we had positive US news. However, I'm still in the mindset of being very bearish on this. So I would quite like to see a pullback of about 50%. So actually back up to this previous high would be great. I'd have a stop. Ideally, to be honest, the stop would be back at the previous swing high up here. But I'm not sure the risk reward is worth it in this case. So I might have to go a bit more aggressive. Possibly just have a stop somewhere around here. And that would do me quite fine. So the aim here would be to see a correction of NFP. We've still not seen this, and I like to see a correction. So oftentimes we'll see a news move. So whether it's bullish or bearish, doesn't matter. And it can take a while, for that to get corrected. But oftentimes we'll see fluctuations and then the correction and then the continuation in whichever direction the market is trending. So that's kind of what I'm expecting here. We're seeing this consolidation, and I would like to see a little bit more of a pullback here, and then I'll enter and just see if we can get that correction. The dollar NOK, now this is another one I've been talking about for a very long time. Actually, I did get my entry triggered up here, but I missed it because I was away, which is quite unfortunate. So I'm just waiting to see if I can get price to come back up here again. And then we could possibly enter. This is on the weekly time frame. It's not really a short-term trade at all. It's something I'm looking to hold into 2025. So yeah, we'll see. But to be honest, if we can get this weekly candle close to engulf the previous two candles, so the bullish candle we have here and then the one next to it, I'd consider adding a starter position, so a lower risk entry, a lower position size. And that would just start the position building process into this move. What's this one? Australian dollar. So the thing is, I really like to trade trends. I like to see these types of moves where we come down, create a low, pull back, and then continuation. So I like to see these these pullbacks within the market. But what's really putting me off at the minute are the weekly candles. So we're seeing a lot of these actually at the moment, as we are sort of coming out of this risk off period. We did see obviously a dump to the downside, and now we're starting to see a bit more of a correction. And this obviously looks like a really strong weekly candle. So I don't really want to be selling into this. So it's a bit of a little bit of a trap for me, to be honest. If I wasn't looking at the weekly time frame, I could quite easily get chopped up in this trying to short these pullbacks. But that's one of those things. You've got to be vigilant. This level also looks really nice. It's really tempting to take this, but it's just a bit too risky for me, to be honest. It's not quite what I would like to see. If the weekly wasn't as bullish as it was, then I would probably be going in short here. Yeah, I'm a little bit behind on economics at the moment. I've not been keeping up. As I said, I was away. I was meant to be away this week, so I haven't really read up on much. So everything I've got, I've mainly been day trading actually. So what I can do is show you So this is my Darwin account. I've just been taking very small positions on the hourly chart, just looking for intraday positions, because that's what I like to do. If I'm not too up to date on economics and I'm just wanting to execute on smaller positions, then I'll quite happily go in for day trades. So you can see it's just relatively small positions building up into a 2% profit here. But essentially just doing the same thing as what I would do on higher time frames, and then just zooming in onto the hourly. I actually live stream my live trading sometimes, so if you guys are interested in seeing some day trades, feel free to check out my channel. Little plug there. Anyway, we can talk about gold. I know gold's quite a big focus at the moment. In fact, gold's been a big focus for a while now. How long has it been since we've been around here? Has it been all year? Essentially all year since February. Gold's been in a very, very big focus. So my opinion on gold is a bit mixed. It's not something I would buy, and it's not something I would sell. And the reason is because I would like to see a lower price on gold, to be honest, and then the continuation to the upside. So I don't really think gold has enough steam at the moment to head really any higher, let alone break all-time highs. And the reason is just because of the market conditions. I think the markets are in a bit of a state. You know, we did have risk off, but that obviously didn't do anything for gold because we saw a lot of profit taken. So yeah, I don't really have a plan for gold, to be honest, and that's quite rare for me. Normally I have something in mind that I would like to see, but I really don't. The only thing I would really see in gold is if we did see some sort of break to the all-time highs, and then enter on a potential retest, and that would be basically it. You know, if we don't see that, the only other option for me on gold is one attempt to buy at the support, and then again take it potentially just back to previous all-time highs. So something like this, but yeah, not too interesting gold, actually. I'm short on silver. I'm not sure if I've got that marked up here, actually. No, I don't. I'll have to show that one next week. But yeah, I'm short on silver. That one's in a bit of a drawdown. I was looking to trade crude. We've seen really nice price action on crude oil. So as I was saying, I like to trade trends. So when we see the daily time frame in a downtrend, we've got the weekly time frame in a downtrend. When we look at the H4, we're in a downtrend. So when we take a look at the hourly, all I'd be looking for is these pullbacks here. So we can see one here, really nice. Got one here. So these are the types of trades I would be looking to take. Unfortunately, I missed all of them. Although it looks like we could now be changing trends. OPEC doesn't really like keeping oil prices low, and we are quite low. I think average oil price should be around $80 or 82 in that sort of area. And now obviously we're down at 76, so it's a bit low. So I would like to just see a slight trend change, and if we can get that, then I'll be looking to go long. We have just bounced off quite a nice level of support here as well, which is quite a nice indication. But yeah, it's just a bit too early for me to be buying. I think it's just not confirmed enough, to be honest. Weekly time frame looks good. We are, you know, we did break the 200, but it's rejected it quite nicely, which is a bit of saving grace for me. Holding period only risk nowadays. You hold drawdown? Yeah, I'll hold drawdown. Doesn't bother me. You know, I've been trading for many years. If I hit drawdown, it is what it is. You know, I've got the way I trade normally is just take profit, stop loss. But things which are more long term, so like my dollar NOK and my dollar yen positions are more long term positions. So I'm happy to let me pull it up on the weekly. I'm happy to go in with these smaller size positions. So you can see the blue lines here are my my buyer entries. So when I enter, it's relatively small, and then I'll enter again, relatively small, and then I'll enter again, relatively small, and that's it. You know, I'm happy to sit through that because I'm confident in the way I trade. And if it does, you know, if the trade is scrapped and it gets to a point where, okay, I've lost hope in this trade, it's not going to work out, that's fine. I'll have to take the loss and move on. What else can I do? I'm not sure what you mean about scalping and drawdown might be a new loss. You've kind of lost me there, to be honest, but that's fine. I don't touch low time frames like that. The lowest I'll go is the 15, and that's just to check pivot points. Anything lower than sort of the hourly time frame is a no-go zone for me. It's just noise. And that's something a lot of people actually don't really account for, is when they're trading, the 1 minute and 5 minute, it's a lot of just corporate funds moving around. It's not necessarily speculative trading to actually drive price in a specific direction. It is quite literally just random. It's very, very hard to trade low time frames. So yeah, I think, to be honest, that's about it. There's not really anything on my watch list. So this is my Australian dollar yen position. You can see this one actually hit quite major drawdown. I did have 3 positions on here. I think I had another one up here, but the loss got to a point where I was like, I can't hold this loss and the dollar yen loss, so I had to cut this one, which hurt a little bit, but it was one of those decisions that paid off. Now we're starting to see some bullish movements again. It should be covered. But yeah, we're just seeing a lot of corrections, to be honest, in the markets. There's not really much else going on. So the Canadian dollar yen looks really nice. We've just bounced off this 200. And I can't count the amount of times I was sat on this stream to say, saying that we need to be careful of the yen. We're going to get an intervention. I don't know when, and also talking about mean reversions. And that exact thing has happened. Now, I'm obviously not trying to make out that I can see the future by any means. I can't. But, I wasn't saying it for no reason. We were very deviated from the 200. That's been fixed. The interventions happened. We're now getting dovish words. So, to be honest, this looks really, really healthy to hopefully head back up to the upside. That's as long as the Bank of Japan and the MOF don't start messing around again and start playing with my positions. But that's out of my control. I can only act on my own things. So yeah, I think that's about it. If there's any, let me just take a look here. Follow the trend. I'm glad you get some value. Thank you. Can you please look at pound Swiss and chat's moving? Can you please take a look at pound Swiss and correct me if I'm wrong? We are overall bearish on higher time frame, and I'm looking at the current move as a correction, and we can look to sell towards lows again. Okay, let's see. We'll use the H4. So you want to look at the 1.06 level. So why are you looking at 1.06 is what I want to know. Oh, I see. Okay, so you're targeting this here. Okay, that makes sense. So let me just have a think. So last time I'm quite under-researched at the moment because I've been away, but from what I understand, the pound still has some steam. Now, I think the pound is running out of steam because, I don't know if any of you pay attention to the UK news, but the UK is in a bit of a hellhole at the minute. However, based on economics and things, I think the pound is okay for now. The Swiss was obviously acting as a safe haven. So when we saw, stocks plummet, the yen gained strength, and in turn, we saw the Swiss gain strength and act, it did its job as a safe haven, which obviously then in turn dragged the pound Swiss down. But I am not confident that this is just a pullback. As I said earlier, I'm in the mind that this risk-off move that we saw was very impulsive, and I think it was very, very, what do you want to say? What's the word? I think it was just very dramatic, really. I just don't think it was needed at all. I think that might be a bit of my bias coming out, to be honest. But yeah, anyway, I just think we could see basically price is correct. I think we could see price come back up and start basically just ranging. Pound Swiss is a horrible pair, in my opinion. But of course, this is just my under-researched opinion at the moment. What I need to do is wait till Sunday, I'll do my research and come back on Monday or Tuesday. And I should be able to give a full, more educated look. But yeah, just from what I know at the moment, I wouldn't be looking to just trade a pullback here. Weekly, if it closes like this, will be a huge bearish engulfing. To be honest, to me, the weekly looks very bullish, but it may just be a broker difference. I don't know. But yeah, to me, this looks like a really strong sign that we're going to head back to the upside. Yeah, no problem at all. Johnny, you want to see Euro Australian? So this isn't a pair that I trade too much, actually. So I'm just going to have to give you technicals on this one. But as I was saying, I think the markets at the moment are basically repricing. I think we saw, again, this risk off move. So, you know, we've seen a huge run to the upside, actually, on the Euro Australian. We saw, what, a 7% gain? When was this? Since July. So, wait, when? July the 15th, less than a month, we saw a 7% gain, which is huge for Forex. You know, for currencies, that's a large move in less than a month. So I am under the impression the markets are just repricing. We'll see a correction to the downside and then a continuation to wherever the Euro Australia wants to go. It could head back to the upside or it could continue to the downside. But as of right now, the markets, in my opinion, are almost a no-touch thing. So that's why I've been day trading, really, is because I'm not looking to get into swing positions, to be honest. Other than the ones I already had open, so things such as the dollar yen and euro Canadian, just a little bit tricky to trade. I think there's a lot of uncertainty in the market. People aren't really sure what's going on. And we very easily could actually start, you know, seeing the risk off move happen again if, you know, the what's it called? Oh, recession. If the recession fears start increasing and becoming more validated, then yeah, we could see the risk off move continue. But personally, I'm not under that impression, to be honest. James, are you doing props? Props, I assume you prop firms, but no, I passed. I think it was Maven. Maven was fine. You know, I've got nothing against prop firms, really. I think they're a great way to make some very quick money if you are profitable, although they're very difficult to trade and actually make money from. But this account is technically a prop firm. So, I've just realized I've been off the camera. My apologies. I don't know how long I've been half on, half off. So, prop firms are a little bit of a gray area. I think, like I said, they're a great way to make some quick money for certain people, and I think there's a little bit of luck involved as well, to be honest. So I'm with Darwin. You know, I just want to clarify, I've got no affiliation with them. I'm not partnered with them or anything. But I think they are very, very good. If you're a profitable trader of the long term, it's a great way to A, get exposure, and to B, build a long-term secure track record. So for example, if you trade a prop firm like FTMO for 6 months and you blow the account, your track record's gone. Sure, you might have a MyFX book, but you can't keep trading it. You're gonna have to start a new one. So you've got no long-term track record. And you are under the mercy of the prop firm. So if the prop firm wants to stop paying you, they very easily can. Or if they don't want to scale your account up, they don't have to. Whereas DarwinX is different in terms of DarwinX traders are essentially inside an ETF. So if I was an investor, I can go to Darwin, give them $100,000 and say, I want to invest in your traders. All the traders participate in the fluctuations of the investor. It's not just me taking an individual investor and trading his capital, if that makes sense. Anyway, I'm not here to do free adverts for other companies, so feel free to do your own research. But that's who I'm with at the minute. I also have a personal account that I trade, but I'm starting to fade out of that one a little bit and do more of my active trading on Darwin and do my more long-term positions on my personal account. So the Nikkei, I'm really salty I missed this one. I was watching it right here. I was sat and I was saying, okay, am I going to buy this? Do I need to buy this? Should I buy it? But I was obviously at this point, I was still quite, well, relatively large down on my my yen positions already. And I just had this concern of, although this looks great, it is very possible we could continue to fall. And I just wasn't willing to take that risk on top of the drawdown I was already sat in. So I didn't take it. And right now, you know, in hindsight, I'm sat and I'm just watching it and I'm kicking myself because this would have been a huge trade. Actually, what's the move on this? So we're already up 16.5% in 6 days, roughly, if that. In fact, probably less than that. Let me just double check. 6, 7, 8, 2 days. 2 days, we're already up 16.5% is incredible. So yeah, I'm a bit salty I missed that one, but what can you do? As I said, hindsight will kill you in trading if you take it too seriously. Bitcoin, I tried to buy some Bitcoin today for the first time ever, and my bank rejected it. Apparently Chase don't accept crypto payments or don't deal with crypto at all. So that payment failed, which I'm a bit annoyed about. But I may just take a traditional, well, you know, a sort of CFD style trade on this one and just buy Bitcoin here. If we can get a weekly closure on Bitcoin, to be honest, anything where it is now or higher will be great. I'd like to see at least something like this. So some sort of bullish signal that Bitcoin could head higher. You know, we failed here. We failed to hold this low. Sorry, we failed to break through this low and it's held. So I'd be more than happy to buy Bitcoin and essentially sit on it. Although, you know, it's a little bit of a tricky one up at this resistance here. So it'd be a case of trying to just trail stops, I think. But to be honest, I think if Bitcoin does decide to rally from here, it could be a really good trade to sit in. We could just see something like this. And then if this resistance does hold and we start making new highs, I wouldn't be opposed to buying again. Now, as I always say, I'm not a crypto trader. I don't really know what drives crypto, to be honest. I'm a very, very uneducated in this area. So take my word with a pinch of salt. And to be honest, I don't know if I will take this just because I only really trade what I understand. And crypto is a little bit out of my territory. I think Trump will pump it. I agree, actually. I think if Trump does get elected, I think we could see a really good run on Bitcoin. But, you know, a little bit of a conspiracy theory here. I just don't know if it will happen because if you look at the history of the dollar, I can't remember the details. I'm not American, but yeah, there's something about the dollar and gold, and then also being backed by something else, and it's just never happened. The dollar has always been very, very protected, whether that's Illuminati or whoever. But yeah, obviously, I think what I heard was Trump wanted to essentially back the dollar with Bitcoin or make Bitcoin the equivalent of a dollar or something, in terms of recognition, the equivalent of the dollar. So it could have a great effect if it happens. I just don't think it will, because I think there's obviously higher powers in the world than Trump and presidents that will likely just block it. But anyway, that's a bit of a tangent, so I'm not going to go into that right now. I think that's it, to be honest. There's nothing else from me. If there's any final questions, let me know. If not, then I'm going to head off. Go and get a cup of tea and end the day. Please chart background color white, please. There you go. He wants to use Bitcoin as strategic national reserve replacing crude oil. Is that it? That's interesting. See, I just don't think that would happen. I think there's too many opposing things. To be honest, yeah. Anyway, I might have to look into that, and maybe I'll make a video about it and try and do a little deep dive. But unfortunately, I don't know enough about that at the moment to really discuss it properly. Anyway, like I said, I'm going to head off. I appreciate you guys as always. Hopefully, I'll see you next week. If not, have a great week. Have a great weekend. Thanks for being a great chat as always, and I will see you later.
Thanks for tuning in to today's A1 Trading Show. Make sure to subscribe and to turn on post notifications so you don't miss the next one. Also, we're looking for more guests to come on the show. If you're comfortable being on camera, have trading experience, and you're looking to grow your audience exposure, we'd love to have you on. In the live stream chat and description below, we'll drop a link to apply to be a live stream guest and join in on the conversation. We hope to have you on soon. That's all for today. Trade safe, and we'll see you next time.